Shares of American Eagle Outfitters are down after the company posted weaker first quarter results and pulled back their outlook. For more on this, let's go to Simeon Siegel, Managing Director of Equity Research at BMO Capital Markets. Simeon, thanks for joining us today.
Good to be here.
So this had to do partly, I understand, with inventory write-down. What happened?
Isn't accounting great? No, so listen, the mechanics of this is the company has decided that some of the product they were looking to sell isn't going to sell at the price they think, so they're writing it down. That's the hit we're seeing today. The more important implication is why. So the idea that now we have product that was supposed to sell that now has to be drawn down, that's not a good sign. The interesting dynamic is this is happening at the same time that we're dealing with tariffs and recession and all the fears and demand. This seems to be different. This seems to be a case of a company did not hit its merchandising that it wanted to hit, which is the most micro and most important part of retail you could have. It just happens to be wrapped in this less than beautiful scenario we're dealing with now, where you're getting hit from all different sides.
Okay, so let's unpack the scenario in a moment. For the inventory, were they just not picking the right products that people wanted to buy? Were they just pricing them too high? Was there any clarity on that?
That's what it did. Well, it seems like the former. It seems like they made a bet. It didn't manifest. They didn't put out the right product, and therefore they're going to have to sell it at a lower price, right? The nuance of this is that they wrote down the product that they're then going to sell go forward, which probably means there's going to be some good deals on American Eagle and Aerie product into the next quarter. They're just taking the gross margin hit right now. And so, yeah, I think very simplistically, we would be having this conversation completely irrespective of tariffs and completely irrespective of demand. This is what happens in retail. Sometimes you make a bet that doesn't work. I think the fact that it's compounded by the current environment and all the risks we're dealing with right now make it particularly interesting. But I think it's exactly what you said. I think they made a bet on product that they believe is not going to sell at the price they wanted it to sell. Okay, so let's filter in a little bit of the climate right now under the banner of consumer sentiment, because clearly people have concerns about their jobs. They have concerns about the economic downturn if it's coming. So how much do you think is consumer sentiment here? So the interesting dynamic is if it was purely consumer sentiment, if it was just recession, what you would have done is we would have seen what we're probably, by the way, in the middle of earnings, we're probably going to see a lot of companies say is they just had to mark down product. They just cleared it through. They said, you know what, the product's not selling. Let's take 40 off. Let's get rid of it and start again. That's not what a write-down is. A write-down is the belief that we are just not going to sell at this price, and we're going to take these cuts. We're just taking them in advance. It's a proactive move. That's very different. If you are worried about demand, you let it play out and you promote in real time. If you simply believe this is bad product, that's when you take the cut now, because in your mind, there's no question that it's going to have to be sold at a lower price. And so, yes, I'm sure in an environment, listen, at the beginning of COVID, when there was no product anywhere, it didn't matter if you had good or bad product, it sold, right? Any dumbbell or any bike or anything that was in high demand, even if it was of inferior quality, sold because of scarcity. That's not the environment. Right now, there's plenty of product, and there's not a lot for now, and there's not a lot of demand. So I think you're right. It definitely is not helping. But I think what we are seeing yesterday is actually not. The easiest way to say this is I don't think I'm about to see a whole lot of companies in this world start writing down a lot of product over the next 3 weeks as they report earnings. Okay. I think this was an Erie specific event.
They are also taking a look ahead and changing guidance, right? So let's talk about trade exposure. How much of their product is exposed to tariffs, which have been sort of winding up and down, but just wondering how much exposure they have here.
Yeah, there's really no apparel business that does not have exposure to at least Southeast Asia. China has been increasing. It's been increasingly lower. And so that's why on that Liberation Day big attack to Southeast Asia, that was where a lot of these companies started feeling a tremendous amount of pressure. They're no different. And so the question of, are we dealing with this reality of now it's that 10%? That's probably what is happening. But obviously over this week, simply the dial back of China made everyone breathe out. That is also because it does potentially help with the demand conversation. So yes, definitely exposed, as are the rest of the apparel and footwear businesses, because it's just not feasible to manufacture this product in the US. I think every little bit that releases, it's less even that the release valve of now you have better cost. It's simply the idea that the sooner we get to an ending, the sooner these companies can start initiating whatever plan they want to do. I've been thinking, and from my conversations with companies, I believe that it's the uncertainty of the tariffs that's been the bigger deal than the actual severity of them. And I know that's an easy thing to say. If you are paying 145%, that's pretty severe. But I think most companies were simply worried about the fact that they weren't sure what plan they were supposed to implement because they don't know what the final result, they don't know what problem they're trying to solve.
Yeah, I think we're hearing that from a lot of companies. Do you think this company can recover from the quarter. And they have a number of brands. So I'm just also wondering which brand saw the hardest hit this quarter and whether you think recovery for all of the brands is possible moving forward.
Yeah, it's an excellent question, an excellent point, because Aerie was the bigger culprit than American Eagle. So their intimates lounge business was the one that was harder hit. Now they're saying it's applicable to everything. Everything has a write down, but it sounds like this was particular underperformance at Aerie, which had, by the way, in recent years been many years, not just recent, been the high growth vehicle of this business. So yes, I think distinguishing that it's not the company at large, its specific areas is fair. It does touch everything, but it has concentration there. So I think that would be the way at least we're thinking about it. To your first question, going back to the interesting mechanics of accounting, there's a chance here that the company just completely took their medicine, right? So flagging the difference between promoting as you go versus taking the hit up front, they are going to sell this product that they now wrote down, which means if it sells for anything better than they accounted for, it actually looks really good. You actually get some health out of the business. And so there is something to the fact that every company, including American Eagle, is withdrawing their guidance, which you alluded to, because of all the uncertainty, which effectively says, you know what, pose even more questions in the future. Whereas the company that's actually taking a markdown or taking a write down, may be the only one that's actually absorbed excess problems today. And so there is a scenario, we don't know, but there is a scenario where they over accounted for this. They were overly cautious, and that allows them to reset. And one comment that they did make, I don't remember the exact words, so I don't have the quote, but one comment they did make in the press release was that they now feel like inventory is aligned with sales. That's a very important line. That could be a little Easter egg that they are feeling good, that they've taken enough of their medicine, and therefore the future looks better. And that's a write down can leave you in a pretty good spot once you have it behind you.
Simeon, got to leave it there, sir, but appreciate you joining us. Simeon Siegel, Managing Director, Equity Research, BMO Capital Markets.